Hey, welcome back to XRP Financial Horizon. If you've been watching your portfolio today and wondering what on earth is going on, you're not alone, and you're in the right place. The crypto market is sliding, and it's not some random dip you can just scroll past. There's a very specific reason this is happening, and once you understand it, the price action starts to make a lot more sense. So let's get into it. Thursday has not been kind to crypto investors. Bitcoin is struggling to hold ground near $64,000. Ethereum is stuck in a tight range and can't seem to catch a break, and XRP has now seen 3 straight days of sellers pushing price lower. Across the board, the mood is cautious, and a lot of that comes down to one institution that has an outsized influence on every risk asset in the world right now, the Federal Reserve. What happened at the Fed's Wednesday meeting, and more importantly what was said after it, has shifted the way traders are thinking about the next few months. The FOMC held rates steady in the 3.50% to 3.75% range, and nobody was shocked by that. What caught people's attention was the press conference that followed. Kevin Warsh, in his first public appearance as Fed chairman after a policy meeting, came out swinging on the inflation fight. He reaffirmed the 2% inflation target as a core, non-negotiable objective, and made it clear that monetary policy is the Fed's primary tool for getting there. That's not the kind of language you use when you're thinking about cutting rates. That's the language of someone who is prepared to hold firm, or go higher. And the context behind that tone matters. Inflation in the US jumped to a 3-year high in May. Oil prices are elevated, energy costs are feeding through to everything. There's ongoing tension in the Middle East that is keeping commodity markets on edge. When you layer all of that on top of a central bank that is clearly not in a rush to ease, the environment for risk assets becomes difficult. Crypto doesn't exist in a vacuum. It responds to the same macro forces that move stocks and commodities, and right now those forces are pointing in the wrong direction for buyers. What's really telling is the shift in where traders are placing their bets on the next Fed decision. A few months ago, even at the start of 2026, almost nobody was pricing in a rate hike. The conversation was entirely about when cuts would come. That narrative has completely flipped. Right now the market is putting a 30% probability on a rate hike at the next meeting. The remaining 70% still expect rates to stay unchanged. But the fact that hike bets have gone from basically zero to nearly a third of the market in such a short time is a big deal. It means the rate cut story that was propping up crypto sentiment earlier this year has quietly been taken off the table. On top of the Fed story, there was a geopolitical development late Wednesday that added another layer of complexity. The White House announced that President Trump and Iranian President Masoud Pezeshkian signed a memorandum of understanding aimed at winding down the conflict between Iran and the US-Israel alliance. That sounds positive on the surface, but the fine print tells a different story. Iran has said it won't return to pre-war conditions, and it has plans to start charging transit fees on ships moving through the region once a 60-day grace period outlined in the agreement expires. So, while a deal has been signed, energy supply disruptions are not off the table. Oil stays uncertain, inflation stays sticky, and the Fed stays hawkish. The chain holds. Sentiment in the market is reflecting all of this very directly. The crypto fear and greed index came in at 15 on Thursday. That's deep in extreme fear territory. The day before it was at 22, which wasn't great either, but the fact that it dropped further in a single day shows that confidence is still eroding, not stabilizing. When the index is this low, it generally means that investors are sitting on their hands. They're not rushing in to buy dips. They're waiting for clearer signals before putting capital back to work. And in this macro environment, those clearer signals haven't arrived yet. Now let's talk about Bitcoin's chart, because the technicals here are worth going through carefully. BTC is trading just above $64,000, and that level is doing some work as near-term support. The price hasn't broken down yet, and that's worth acknowledging. But the chart structure is not bullish. Bitcoin is currently below its 50-day, 100-day, and 200-day exponential moving averages all at once, and each of those averages is sitting above the current price as resistance. The 50-day EMA is near $70,062. The 100-day is around $72,838. The 200-day is up near $78,241. Together they form a thick ceiling that Bitcoin would need to work through to get back into a genuinely healthy trend. The momentum indicators are a bit more encouraging than the price alone suggests, and that's worth noting. The MACD histogram is still positive on the daily chart, which means buying pressure hasn't completely collapsed. The money flow index is sitting just below the neutral 50 level, suggesting that money isn't flooding out of Bitcoin either. So there's still a tug of war happening, but the bears have the structural advantage right now. price is below the trend, the macro is unfavorable, and the overhead supply is heavy. Buyers have a lot of work to do before this chart turns constructive again. On the downside for Bitcoin, the level that matters most is around $62,149. That's where the parabolic SAR currently sits. The parabolic SAR is a useful indicator for identifying when a trend is shifting, and a clean break below that level would be a warning sign that the near-term selling is accelerating. Below that, there isn't a lot of obvious technical structure to lean on in this price range, which means a breakdown could move faster than people expect. $64,000 holding is fine for now, but if that $62,149 level gives way, the situation changes quickly. That's the number to watch on Bitcoin this week. Ethereum is dealing with its own version of the same problem. ETH is trading around $1,747, which keeps it above the $1,700 demand zone that has been providing some floor, but the overall bias remains negative. Like Bitcoin, Ethereum is sitting below its 50-day, 100-day, and 200-day EMAs, which are spread out in a range from roughly $1,946 up to $2,375. That's a wide band of overhead resistance, and the price is well below all of it. The MACD histogram is still positive, and the MFI is near neutral, which mirrors Bitcoin's picture. Momentum isn't collapsing, but the trend is still down. For Ethereum to start building a credible case for recovery, it needs to get back above $1,945, which is where the 50-day EMA sits. That would be the first meaningful sign that buyers are pushing back. After that, $2,103 and $2,375 are the next significant levels to reclaim. Those are not small moves from where ETH is trading right now. On the support side, the parabolic SAR near $1,603 is the line in the sand. Losing that level would be a technical red flag, and it would suggest that the downside for Ethereum has more room to run. Ethereum is in a holding pattern right now, not breaking down hard, but not building toward recovery either. XRP has had a rough few days, and the data across both spot and derivatives markets confirms it. The token slipped below the 1.20 support level that traders had been watching, and it's now sitting around $1.17. That break wasn't dramatic, but it was meaningful. And what's happening in the futures market reinforces the bearish picture. XRP's futures open interest dropped from $2.79 billion to $2.66 billion in a single day. That decline tells you that traders are closing out positions rather than opening new ones, and the ones holding long are starting to reduce their risk. It's not panic, but it is a quiet retreat that confirms the lack of conviction on the buy side. The XRP chart structure is consistent with what we're seeing in Bitcoin and Ethereum. Price is below the 50-day EMA near $1.28, the 100-day EMA around $1.37, and the 200-day EMA close to $1.58. Each of those levels represents resistance that would need to be cleared before you could reasonably call this a recovery. The one thing working slightly in XRP's favor is that the MACD histogram is still above zero, which suggests the selling momentum, while present, is not intensifying. It's grinding lower rather than collapsing. But grinding lower is still lower, and the support level that matters most sits around $1.08 on the parabolic SAR. A break below that number would be a clear technical deterioration for XRP and would open the door to further losses. Here's the honest summary of where things stand. The Federal Reserve has shifted the conversation in a meaningful way this week. The door to rate hikes, which almost nobody was talking about 3 months ago, is now cracked open. Inflation is the reason, and it's not going away quietly. Crypto is absorbing all of that in real time, and the charts for Bitcoin, Ethereum, and XRP are reflecting exactly what you'd expect in a hawkish macro environment. The key support levels to keep an eye on are $62,149 for Bitcoin, $1,603 for Ethereum, and $1.08 for XRP. Those are the floors. If they hold, the market may consolidate and find some stability. If they break, the next few weeks get more complicated. Keep those levels on your radar, stay patient, and we'll keep tracking this closely right here on XRP Financial Horizon. See you in the next one.